Welcome to Property Addicts Australia, your home for everything property investing. Get an insider's view of what really works when building a portfolio. Learn how to avoid the common mistakes, plus get all the tips and tricks from the property investing experts Sana and Mona Ali. Join us to learn from the experts and set yourself up for long-term success in property investing. Proudly powered by propertytwins.com.au.
We get asked questions by first-time property buyers and property investors, and for every time we had $1, we get asked these questions. And the top one is, do I buy my home first or an investment property?
It's a common confusion that first-time buyers have. Some of them may believe that, buying an investment property it might put them ahead versus buying a home. But, there are some implications of going down one path versus the other.
There's no right or wrong answer, but what you need to really consider is the first home buyer benefits that different states offer, with especially the first home guarantee scheme that lets you purchase a property with no lender's mortgage insurance and literally a 5% deposit and up to a certain price point. Say in New South Wales, it's $900K with very little stamp duty. No stamp duty up to $800 and up to $900 with very little stamp duty.
So there's obviously stamp duty concessions which are state-based. Not all states have them, but many do. So if you're a first home buyer and you are thinking, well, I only have a 5% deposit. So not only do you have like the first home guarantee where you can get away without the lender's mortgage insurance. There are some lenders who lend for that. You're pretty much not paying any LMI because the government is guaranteeing that. So no lender's mortgage insurance. And on top of that, if you buy it as your first home, you get better interest rates as well, like under the first home guarantee.
And as an owner-occupied property, which is better than investment rates.
Yeah, but something you need to be mindful of is your income levels, because if your income goes beyond a certain threshold, then you may not be eligible for it. So there are different thresholds if you're single versus if you're a couple. And also there are caps on purchase price depending on whether you're buying in a city or whether it's regional, and each state has their own thresholds.
Some people also consider, let's go buy an investment property. But what you need to consider with an investment property is typically with most lenders, you are putting at least a 12% deposit, including lender's mortgage insurance. It becomes a 90 LVR loan maximum. So what that means is your savings don't go as far as they could with a home with a 5% deposit and no stamp duty. With an investment property, you are paying stamp duty from the first dollar. There's no concessions with that. So for that, you need to at least account for 5 to 6% of the purchase price for stamp duty, solicitor costs, building and pest inspections or strata inspections. And that means, a lot of it is in a way dead money.
But the thing is, right, often people are thinking, well, if I bought a home, there's limitations with that. I want to live in a certain area. I do not wish to move outside of where I've been living, and I can't afford to buy in my current location. Even then, for example, using Sydney as an example, you may be living in a certain pocket and you may not want to move, but you really need to weigh up, is it worthwhile buying a property, potentially moving in for a period of time, utilizing the first home buyer benefits, getting in the market and having exposure to this market already, and then converting it to an investment property down the track.
Depending on the state, you might need to live in the property 6 months or 12 months to qualify for these benefits. But is a short-term sacrifice worth it to get into the market? Recently, I was analyzing this for a client where at first we thought, okay, they were going to buy their home. They were renting at the time. For home, they had sub $90,000 saved up. With the stamp duty concessions and first home buyer benefits, they could buy up to $900K purchase price for a home. And then they thought, okay, how about, can we consider an investment property just so we can buy anywhere and in any state? And then we did the numbers. But based on the funds they had available, borrowing capacity, and a combination of factors, they could only really buy a 450K property. And, it would be a very different asset quality that you can buy for a 900K purchase versus 450. Especially if you are building your foundation portfolio, starting out where thinking you will be a property investor down the track, you need a quality asset. Starting with a cheapy 450 property may not give you the equity that you're needing to move forward.
And so often people may go and buy in, say, hypothetically regional locations, with very little upside for the long run. These locations may be hot in the short term and you might want to get on that bandwagon, but really longer term, is it actually going to help you create wealth? And that's what most people are looking for, right? To create wealth for their futures.
Well, that's where these clients decided they are going to buy a home to get into a property which can give them the capital growth. And of course, you need to consider the borrowing capacity. Let's say if you've bought an investment property, would you have any borrowing capacity left? Sure, incomes might go up, lending climate might loosen up, and you might have borrowing capacity down the track. But right now, can you expand that? And I think another thing people need to be wary of is 99% of the times when clients come to us and they say, I want to buy an investment, they'll always say, I've bought this investment, now I want to buy a family home. So where do I get the funding?
Well, I've had a number of clients who've gone down the path of rentvesting initially. They've built a property portfolio only to realize, okay, well, ultimately they wanted a family home and they've had to go back and sell their investment properties to free up borrowing capacity to buy that home. Purchase costs or, entry and exit costs are quite high in real estate. So you need to really weigh up what is actually right for you. Another key thing you need to consider and discuss with your tax accountant is the income tax implications of buying an investment property first. Because say you save up a deposit, you put that deposit towards an investment property, and that investment property potentially doesn't grow in value, or it may take a long time to grow in value. Then you need to consider, how long will it take me to actually save up that deposit for a future home or that next property? And what if you're unable to then tap into the equity, or even if you were able to tap into the equity of that investment property, that is really borrowed money. It's not, if you're using that money to buy a home, it's non-tax deductible.
Well, you won't be able to get the first home buyer benefits either because you've already gotten into home ownership. Well, of course, check with your local Office of State Revenue, but under most circumstances, you cannot avail the benefits available to you as a first-time buyer. Because with these clients, right, the 900K purchase, they will need at least 90,000 deposit rather than the 5% they're putting in, which is 45 grand, 90,000 deposit plus up to 40 grand in stamp duty, which, they're almost getting for maybe 10 grand at this point in time. So they are getting into their home for maybe less than $60,000 versus needing 130, 140K. How long will it take for them to save up if the investment property doesn't give them that equity?
So ultimately, you need to really weigh up various things when you're making this very important decision to start your property portfolio, whether it be with your first home or an investment property, because this could impact the trajectory of your property portfolio. And those are the type of conversations we have with our clients or have had over the years. And some of them have gone on from buying their first home to multiple investment properties. Like one of my clients, we met in June 2018. And at that point in time, they had spoken to a few people and they were considering whether they should just go buy an investment property. And they ended up buying their first home with about a 10% deposit, and they had to pay some stamp duty because it was in Sydney. So 6 years, onto their third investment property, or being fourth property in their portfolio. And the thing is, by ticking off their home and having a place to call home, they've obviously progressively paid that down as well. So you need to have these conversations, right? We have them with our clients so they can make an informed decision or be a sounding board for their goals and what they can achieve.
Well, and also home, right? You're buying in a quality location, you would think, where you can gain that equity. And this family have done that with their investment properties and with their home and then investment property. So they don't just have one source of equity. Now they have 3 sources of equity, and they're on to their 4th one to purchase their 4th property. And, they're single-minded about what they want. They haven't deterred from their goal. I mean, they could have started with an investment property, but I don't know if this is the outcome they would have ended up with.
Yeah, I guess it provides you stability and, control and, living in one place. If you're rentvesting, then you have to keep moving, potentially if the landlord decides to sell their home, etc. So you need to really weigh up really what's important to you and make it happen.
Yeah, and there's nothing wrong with rentvesting. It's just home buyer benefits do outweigh what you can do right now in the current climate. And why not use it to your advantage? Move towards property ownership with less of your own funds. Get into the market sooner.
Yeah. Well, when we were starting out, right, there was no such guarantees available where the government would guarantee the lender's mortgage insurance. So we had to pay the lender's mortgage insurance. We had to pay higher interest rates to get in the market. Whereas in your case, currently, you may be able to get in the market with a smaller deposit, lower interest rate as well, get exposure to that market. And you may still have money left over, maybe for an investment property down the track as well as part of this. So you need to plan well.
The next question we get asked is, do I buy one expensive property or 2 cheaper properties? Let's say talk about 2 $650K properties versus one $1.3 million property.
So talking about buying 2 properties, so there are obviously pros and cons, firstly, of each of these approaches. Buying 2 $650K properties means that, you are spreading your risk. You can buy in 2 different locations. One maybe in one state, another maybe another state. So that means you're spreading, obviously, your risk. You're diversifying into 2 different markets. You'll benefit from each of the places' property cycles or where they're at in the property cycles.
Lower entry costs for both properties because obviously you need to account for the deposit, the stamp duty. You are likely to have a better rental yield if you are putting in 2 different assets. You can hold one or hold 2 properties. When one is vacant, then you are still covered for part of the mortgage on the second one with rental income. Mm-hmm. And when you come to selling as well, when the values increase, let's say the values double, sell one, pay the other one down, or spread the tax as well, obviously subject to your accountant's advice.
And land tax, right? You may not be hit with substantial land tax because you spread it in 2 different states because each state has their own land tax threshold. So you're obviously overall reducing your costs to hold the asset.
The cheaper properties will turn positively geared a lot sooner than a more expensive purchase. But there is obviously downsides to buying 2 properties as well. You're paying 2 council rates,
2 water rates, 2 lots of insurances as well.
When you acquire the property, you're doing 2 building inspections, 2 solicitor costs, conveyancing costs, mortgage registration charges. So obviously there might be a little bit more extra outlay on holding costs as well as acquisition costs of the property.
And having 2 assets, in 2 different locations may mean if value of one increases sooner, then you'd be able to tap into the equity and you'll be able to expand into another property potentially.
Yeah. Though cheaper properties obviously are in less desirable areas, for the lack of better way of putting it, with where the market's at, you will be going into entry level areas with that sort of a budget. Again, depending on the city, the state that you're purchasing in. Unfortunately, some capital cities don't even have 650K houses anymore. So you might have to consider strata properties for that to account for the strata costs you might encounter.
Then moving on to one expensive property, say you bought one property worth $1.3 million rather than 2 $650K properties. So there is a higher chance you may get into a blue chip area, which is more owner-occupier driven, which may help with future capital growth. And you can tap into that equity and you expand that into another property. However, you'd only be exposed to one market only. When you're exposed to one market, you're just reliant on that property growing and giving you the equity.
But imagine the negative cash flow on that, because the more expensive the property, the lower the rental yield, right? It's more driven by capital growth. Rental yields tend to be a bit lower. But think about when you have vacancy and you have to pay that entire mortgage and none of it is being covered by rent. So then it might take a big cash flow hit. But 1.3 mil, right, in this example could get you into, as you said, an owner-occupied area. But you can also look at properties with future development potential, which you can subdivide or redevelop down the track. But again, they come with the downside of significantly negative cash flow. However, a better future upside. But you can do something with the property.
Yeah, but you just need to be mindful of what it's going to cost you to hold, right? Like, is it going to be impacting your lifestyle? Assuming it's an investment property, of course. So you need to weigh up what sort of what is it going to cost you to hold on a month-on-month or week-on-week basis and an annual basis, and allow for that extra funds in your budget. But again, there's a trade-off, right? You may incur that negative cash flow, but you may be able to generate equity sooner to be able to expand your portfolio.
But it will impact your borrowing capacity though, because the rental yield is so low. Expanding that portfolio may be difficult. So sometimes people think it's about the number of properties. It's not really, but having multiple properties could help your borrowing capacity overall.
And manage the cash flow effectively, right? Because how many of those could you afford, right? Like how many, if a property was, say, hypothetically costing you $1,000 per month versus $2,000 per month, how many of those could you actually practically afford on your income? So another question that we get asked often is, do I go for capital growth or do I go for cash flow? The challenge with that is that investors get so fixated on cash flow or neutral to positive cash flow, which, by the way, is non-existent in many markets. They end up buying properties in dud locations. Like they buy lemon properties in locations which may be showing good cash flow right now, but long-term will not really add to their overall goal.
Well, when you're starting out, you need quality assets in your portfolio, which give you the foundation and the equity to continue expanding your portfolio. It's not about just buying one property and stopping at it. If you're looking at property from a point of view that it needs to be a vehicle for your retirement, then you need more than one, right? Because it's compounding. If you have, say, a $2 million paid off portfolio versus just one $650K property in a bad location with no capital growth and amazing cash flow, you will not be able to get full exposure because capital growth is what builds wealth. And obviously, when capital growth happens, rental yields catch up, and that's what's going to give you cash flow. So a 5% return on a $2 million asset base versus, say, 10% on a $650K purchase. What do you go with? Because again, you'll have the cash flow, but you won't have the equity to continue expanding your wealth. And ultimate goal is wealth creation.
So don't just purely make your decision based on the perceived positive cash flow right now. Because say hypothetically a property may be neutral to slightly positive, but one maintenance cost incurred quickly erodes that positive cash flow. So it's pretty pointless. So get yourself a quality asset, which will actually give you the equity to be able to expand your portfolio instead.
Well, that's where balance is good, right? Balance of capital growth and cash flow. But without capital growth is important. Cash flow is a lifeblood of a portfolio, but capital growth is essential because without capital growth, you kill your leapfrog strategy to be able to move from one property to the next and the one after that. And that's what most investors want to build wealth for their future. You also need to be mindful that rental yield is inversely proportional to capital growth, and it could indicate the capital growth that's yet to come. So our focus has been capital cities, and that's where we are looking at, this is what the rental yield is at this point in time. It's high enough. It may be negative given the current climate, but it could indicate what's to come.
That's right. So capital, so if the rental yield is decent, it attracts more investors because those properties cost less money to hold. Then more investors get interested in an area, that pushes up prices and you get a bit of capital growth. And also higher rental returns also encourage owner-occupiers to go buy their own home because the rents may be a bit high for them, and they might say, well, look, if I bought my own home, it might be cheaper for me to pay my own mortgage versus pay someone else's mortgage or paying rent effectively. So you need to just make sure that you're buying the right quality asset in the right location and not purely making a decision based on rental returns alone.
But that's where people end up in one-horse towns or mining towns, and that's very short-sighted. Look at the bigger picture.
I think, though, it's not just mining towns. There have been certain locations which are really driven by investors currently, and when these investors leave these markets, there will literally be no capital growth down the track. So they're popular right now, but are they actually sustainable? Do they actually add to your future wealth?
So if you were asking this question of us today, we would say go for a balance of capital growth and cash flow. That way you'll be able to expand that portfolio and build real wealth for yourself and expand beyond just one property. Again, going back to the point, capital growth is what builds wealth long term.
Another one that first-time buyers get caught up in is, should I buy near where I live or should I buy a property interstate? So you may feel comfortable buying where you live or near where you live or within that particular city. So say hypothetically you live in Sydney and you may say, well, I must buy in Sydney. Or you might live in Brisbane, Melbourne, so on and so forth. And you might consider that, I need to buy within my city and I feel more comfortable with that.
Well, not necessarily a good idea because there might have been a lot of capital growth that's already happened where you're located. And there might be other markets within the country which might offer you better capital growth. This is for investors specifically, right? If you're just purely investing, then you need to see where each of the markets are in the property cycle. Some regions have had more growth. Other regions will have growth. That's the key point.
And some markets might be depressed or, for all we know, the location you are based in, the market might be a bit depressed. So it might be a good opportunity to get in that market. But on the flip side, though, what I've seen is when a market gets negative media attention, people really get turned off that market. It's understandable. That's human behavior, human nature to feel that way. But what many people fail to see is that if this market is depressed or giving a bad rep, then other people would be pulling out of that market. It might present excellent opportunities to you as an investor to get in that market.
However, if you are a home buyer, then it makes sense where you buy. But I've had clients Sydney-based clients who said, well, Sydney's unaffordable. They've actually gone and bought their family home in Melbourne. Of course, their employer has written a letter that the lenders accepted that they'll be either working from home or they're relocating to a new office. And that's where they've gotten into a more affordable property interstate. Again, where you might be living, it might be very expensive and it may suit your lifestyle. And then you're thinking, okay, let's buy an investment property elsewhere, unless you are fully looking to relocate yourself, which people have done for purposes of home ownership.
Yeah. So I would say make decisions based on actual information, not what the media is suggesting to you. Where you live, the city you live in, it may well be the right time to buy there as well. But then you should consider whether you should actually buy it as your first home rather than investment property, so you can actually access the first home buyer benefits as well.
But you might have better market knowledge anyway if you're buying where you live. But yeah, look at property cycles, especially as an investor. Expand beyond your horizons, because you might get better equity elsewhere, again, to leapfrog in your portfolio.
That's right. So you could just pretty much follow the cycle across the country, buy in one location and that market takes off. Then you buy another location, that market takes off, and so on and so forth. And that's with the benefit of hindsight, having been through the last property cycle. So over the last 15 years, we can actually see it happening, or our clients being able to go from one market to the next and the one after that, and really expanding their property portfolios.
Well, another one we get asked is, do I buy a house, townhouse, or a unit? When we started our own portfolio, we started with strata properties like villas, townhouses, and a unit as well. And there was good reasons for that. When we started, these properties required lower cash outflow. Insurances were covered by the body corporate. It was cheaper to get into the market, and that's what affordability allowed at the time.
It was lower entry costs effectively. It needed a lesser deposit, less stamp duty. And the rental returns were much higher for these properties. So it meant that these properties cost little to nothing to hold, and they could pretty much self-sustain themselves. So that was our driver really for buying strata properties. And another one was obviously, the deposit, right? We didn't have sufficient deposit to be able to buy houses.
So people often look down on buying a strata property or townhouses or villas. But look, if it gets you in the market, it's better to be in the market than not in the market. Obviously, houses have their pros, right? You get the land component. You don't have any wall sharing. You can demolish the property, redevelop down the track. But houses do come with maintenance as well, right? Depending on the age of the property.
That's right. So larger block, older house may have higher maintenance costs, lower rental return in comparison to some of the strata properties, more maintenance, more upkeep overall, but better capital growth. Actually, if we were to look back and compare the strata properties we bought, which did really well, with many more than doubled in value as well in our time of ownership. But a house would have also given better capital growth and better upside. But we looked at what is it that we are able to afford right now, and we took action based on that. So do not get fixated on that you must buy a house, because you don't need to. You can get a strata property.
You just need to get started. Of course, with houses, there's no wall sharing, but say townhouses and villas, you have wall sharing. Often people don't like that. But again, you're getting a better rent to return. You're getting access to the market. So you're better in the market than out of the market.
Another example that I have is actually about 2.5 years ago, we purchased a property for a client in Brisbane. It was a small complex, maybe about 6 units in there. Very, very close to the city, in a highly sought after area. With
very affluent.
Yeah, affluent area where houses go for more than $2 million median price. So we bought this property for sub $360,000. This was 2.5 years ago. And this property would be touching 600K plus as of now. So this client did well. And this is all they could afford at that time. Had they not taken action, and had they waited out to either improve their borrowing capacity, most likely improve their borrowing capacity, they would have missed out on this capital growth completely.
They'd be paying $650 for the same property today, and that takes a lot more cash outlay. So they got into the market when they could. Yes, there's strata cost, but you have to remember strata also covers the insurance for common areas and the property, as opposed to houses where you have to fund the insurance yourself.
So would you rather have the capital growth that, say, this client has had, or would you wait to be able to buy a house down the track?
Yeah, though with units, it depends. You referred to a boutique complex with 6 units. I think it becomes problematic when you're buying in a very high density complex. And I've seen people where they've owned apartments in the likes of Mascot, Walleye Creek, very high density complexes. And over the last 8 to 10 years of ownership, all they've had is 3% annualized capital growth, which is bad. And in this instance, this couple, when I mentioned, is there a reason you bought these properties? they said, well, these properties have been our former homes. And what clicked for me was one of them said, it feels good saying we own 3 properties, but actually what are these properties really delivering for us? So in that case, the units were in high density complexes. With high density comes with very high strata as well.
Again, you need to make an informed decision. Having bought, obviously we bought a unit for ourselves or our clients, and townhouses, villas, and many, many houses for our clients. There's no one size fits all approach.
Yeah, but going back to the unit piece, right? You're also looking at too many people to work with when it comes to the body corporate. That's another problem. And conflict, there could be major conflict, lifts, pools, tennis courts. They're not adding to your own lifestyle, especially if it's an investment property.
Yep. And it could also be a building which is rendered, right, or painted. Imagine if one owner wanted to paint the entire complex and
of 5 or 6 buildings.
Yeah. And then one owner or multiple owners, who really want this painted, and then they raise a special levy there and you have to fund that. So there are good unit investments like this client who bought in a small complex versus there's not so good ones that includes high density, high rise buildings. And many times even lenders don't like to lend in some of these pockets.
Yeah, so they're expecting you to put in, say, a 30% deposit even in some of these locations because either the lender has a lot of exposure or they think there's just way too many. So when it comes to a fire sale, they want to build in enough equity or funding from you before they lend on it.
And I guess that's a lesson we learned very early on when we tried buying 2 off-the-plan apartments for ourselves, that if a bank doesn't like a location or a property, why should you actually be investing in that?
That's such a great question. So when you're going to buy, always check, even if you're buying a house, check with your broker to find out what the postcode policy is, what postcode lookup allows you to purchase. Are there any restrictions with deposit percentages? Or even would the lender even lend you in that location? Especially, say, again, going back to these high-risk towns where a lot of people are buying even houses. Some of the banks are not lending in those locations or wanting you to put a very large deposit.
It's very telling, right? Like, why is a location looked down upon?
Well, recently I had someone purchase a property, a client, and the valuation came short than the purchase price. I believe they still proceeded with the purchase, but the problem is the valuer doesn't think that property is worth that much. So why are you offering that much? But again, we are digressing a little bit here. House versus townhouse versus unit. They're all decent investments. It's just what you are choosing between them. A house can be very costly. The wrong house can be very costly as well, just as a unit or a townhouse can be.
So weigh up, right? Your pros and cons. Each investment needs to be reviewed on its own merit.
Well, let's say we've thrown in that question ourselves. What should I be looking at a property level? Everyone's talking about location, the boom locations, where should I be buying? And often people just end up buying any property and they don't even consider what they should be looking at the property level.
So there's so much due diligence that goes into that, and looking at our own list, and that's not exhaustive list. We came up with a list, like we were looking at 60 different things, and I'm sure it's more than
that's a starting point.
There's a starting point, 60 different things, and if the property does not meet that criteria, then it's a no-go. And these things range from environmental factors such as flooding, bushfire hazards, and then there could be things like easements on the property.
Cyclones, actually, from an
or
environment.
insurance costs, right? Insurance costs associated with a particular location. So that should form part of your due diligence.
And looking at the house itself, you're looking at the land shape, the block size, the slope of the land,
retaining walls,
drainage on the property, easements.
Yeah, there's retaining walls. Are there really high retaining walls in an area? Is the land actually in backyard sloping towards the house? Like, what drainage issues could that cause down the track?
It may look okay in the pictures and all, but this could be very high maintenance costs down the track. And again, it could be landslides as well, where there's a lot of slope on the land in an area.
And it could be near massive green areas, causing potential bushfire hazards for that particular property.
Yep. And there's things that you cannot see when you're doing a visual inspection of the property, things that are only revealed when you do a building and pest inspection or a structural inspection. Those things you can't pick with your eyes.
Like it could be moisture in the bathrooms, right? Moisture in the bathrooms. It could be sagging ceilings. Some of these things only get really picked up as part of building and pest. Some we are able to see just as is and make a decision. Okay, well, the eaves, for example, I use eaves as an example. There's a bit of like staining there. So there might be a bit of a leak happening there. Some things you can pick on, but other things you can't pick on.
Yeah, and then you're looking at the room sizes, the floor plan, the flow of the property, how many living areas the property has. Does it have a patio? Is there any backyard area? We've got what's called a trampoline test. So when we are looking at any property, we're like, okay, can we put a trampoline in the backyard?
And if the answer is no, then that property is a no.
It's a no. So as you were saying earlier that, we have a list of 60, which is a starting point. So more often than not, we're looking for reasons why we should not buy a property. People look for reasons why we should be buying a property, but we are looking for reasons why we should not buy a property so we can quickly disqualify that as even an investment grade asset.
So we discard more properties than we actually choose, and more often than not, the ones that we do shortlist, if we find reasons to discard it, we'll discard it or not proceed further with it.
Well, looking for reasons to not buy a property does make it hard to zero in on the right property. But when you do zero in on the right property, you cut through so much noise and it's the right property very, very quickly when you have a list of no-goes.
Non-negotiable. So you need to your negotiables and non-negotiables. And over the years, we've obviously come up with a large list of non-negotiables because you're not buying that property for today. You want to make sure there's resale value. The key test will be, like in a slow market, if you had to offload that property, what sort of demand will that have? Does it actually have good resale value? And it's not an issue until it's an issue.
Well, talk about people buying on a busy roundabout. Yeah, and just because every property is going up doesn't mean it will indefinitely go up in value.
Well, I had one of my clients share a property and they said, my friend bought this particular property and it was right near like a very busy roundabout right next to it. And I said to them, look, these are the reasons why I wouldn't buy it. And they actually got it. And they said, okay, we would definitely not want to buy such a property, which was, say, next to a roundabout. I mean, there may be properties close to a roundabout, but this was actually a busy roundabout.
So when your friends are telling you they bought an amazing property, there's always reasons why it may not be the right one for you. Don't go just at the face value. Ask a lot of questions about the property itself.
And you can't compare. It could be an orange and a carrot. You're comparing. We are looking for something that's good quality, which will be set and forget for you long term and have excellent resale value and not have issues down the track.
And owner occupiers wanting to buy that property as well. And so there's different levels of it. There's obviously you're looking at the location, the infrastructure, but then you're also looking at the property level itself. Yeah. There's a lot more to it.
Don't just go that, this is the next hot spot, for example.
Don't throw a dart board.
Yeah, dart on a board.
Don't throw a dart on a board and say, I'm buying this house. No, well, it needs to be the right house.
Yeah, just because an area is going up or a region is going up, don't just buy for the sake of it. Do your due diligence. Look at, what are the things that would actually disqualify.
And it's a problem if most houses tick your boxes.
Yeah, it's a problem. That means you don't know what you're looking for. You don't know what the right asset is.
And if you don't have a list of negotiables and non-negotiables, then again, all houses will look the same. So make sure you're very, very clear on what you would discard, what would qualify as a good property for you.
Yeah.